getting your taxes right for 2020 and look at ways to save money on taxes down the road. I'm Eric Brenner. Join me right now for Your Wealth Health. Hello and welcome to Your Wealth Health. I'm Eric Brenner, owner of Hilltop Wealth Solutions, joining you from our office in Fort Myers, Florida. Thank you for joining us today. If you're watching us on Facebook, please share us with someone who could use this information. And we also want to thank those of you watching on yourwealthhealth.com. Joining me today is Bill Davis, a private wealth advisor for Hilltop Wealth Solutions, and Matt Arends, our director of wealth management, and both are in their home offices as we continue to practice safety protocols during this pandemic. Today, we're going to talk about tax preparation and tax planning. The two of them should go hand in hand, and we at Hilltop Wealth Solutions really are committed to helping you manage them both with a coordinated effort. Tax preparation is the effort to get your taxes filed by April 15th, and everyone's in a hurry to get that done. And you want to make sure that you comply with, obviously, the IRS guidelines. Tax planning is an effort really to proactively look at your financial situation and minimize the tax burden for the short term and the long term. So really, tax planning helps you keep more money. So Bill, why don't we start with you? Why is it both really important that we at Hilltop and as financial advisors feel like this really needs to be a coordinated effort?
Yeah, thanks, Eric. It's, there's just there's a lot of things that impact an individual or a couple's tax return. Think about interest. Think about dividends from dividend paying ETFs or stocks. Think about capital gains. So many times people utilize mutual funds that kick out capital gains even without their knowledge. So that can be an issue. Different income streams are going to be treated differently. It's especially becomes important, Eric, when we get to Social Security age. So, for a single person that would have income over about 24,000, their Social Security would begin to be taxed at 50%. For a couple, that would be 34,000. So we need to understand where the income streams are coming from, the types of income that a client is receiving, to determine the taxability of other things like Social Security.
Yeah, Matt, Bill mentions this, the mutual funds may pay out capital gains and you don't even realize it. And often we call that phantom capital gain income. So for our viewers, maybe just go into a little bit more detail on really what that is.
Sure. The phantom capital gain, if you will, is although your traditional capital gain comes from when you're making a purchase and selling subsequently, it's either spinning off a capital gain or a capital loss. So you control that. In the mutual fund, oftentimes there's going to be capital gain distributions at the end of the year because the mutual fund company is buying and selling within that fund. So as they're making transactions for their investors, it's spinning out capital gains along the way. And as they pass those on to the individual investor, if you own shares, you own a portion of that. So you might be even owning a mutual fund sometimes for just a couple of days, but can absorb a year's worth of spin-off capital gains. So it's something to pay attention to. It's something to monitor and control. And it's also why we're seeing kind of a shift into the ETF world where people can control those capital gain distributions.
And that's a great point. And, I know we all as advisors have received that call from a client that says, I don't understand. I got $10,000 of additional income on my tax return. Where did it come from? I didn't sell anything. And that's exactly where it came from. So Bill, there's been independent surveys done of advisors. And the question has been asked many times, do you collect a tax return from your clients? And it is a high number of advisors that don't even collect a tax return from their clients. And we just think that's pretty silly.
Yeah, I don't understand that, Eric. I mean, it's a foundation, it's a fundamental document that's going to help us direct the types of investments that we're going to see that's appropriate. So being a fiduciary, we can only recommend products that are appropriate for the client. How would we even know what would be appropriate if we hadn't reviewed the client's tax return? So it just seems silly to me that such a large number of advisors aren't collecting that most critical document, and that's last year's tax return.
Yeah, it really does. So 2020 obviously brought a lot of changes, and the global pandemic. So Matt, we've had some kind of unique to that situation, stimulus checks, a lot of people collecting unemployment, still collecting unemployment, and then the paycheck protection program. So let's just go into that. Is the stimulus checks taxable?
The stimulus checks are not taxable from our understanding at this point, Eric. So that's one good relief for most people. Unemployment benefits, however, are. So if you were receiving an unemployment benefit from the government, that will be taxable to you. So oftentimes they'll ask you if you want taxes withheld in preparation for that. Many times people do or do not. It really just depends on the situation. But I think oftentimes people don't. The government would try to get you to withhold some. So that's going to be something that hopefully people did withheld money for taxes. And if they didn't, hopefully they just save some up on the side in their bank account. That way they don't have too big of a tax bill. But it is something that will be taxable to you.
Yeah. And hopefully people did realize that, because you don't want this big tax bill. So what was, one of the programs, Bill, we saw that was really helpful with the small businesses was this paycheck protection program loans. Just high level, how passing of the CARES Act, how's that going to be taxed for them?
Well, if properly handled, Eric, it shouldn't be taxable at all. So the PPP money, the payroll protection plan money, should have, was allowed to be used for, I think, up to 25% for payroll, and the remainder for business expenses, rent, utilities, lease payments, mortgage payments, things like that. So, so as long as you comply with the filing reports, the after the fact filing reports that your lender can help you with, you should be able to document that you protected jobs and you use the funds appropriately, and you should be able to then allow that to be a forgivable, basically a grant from the federal government. If you, but you do need to complete the documents after the fact, and again, most lenders are prepared to help you with that.
Yeah, thanks, Bill. So, Bill, we talked earlier about this coordinated effort, really, and what we think is really important. And of course, people right now are in that tax preparation mode, and their documents will start to come in. But looking beyond that, we think it's really important to have a sense on 2021 and what your taxes are going to be. That's planning, having an understanding what your taxes are going to be in 2021.
Yeah, this is a really critical planning year, because we estimate that it's likely that the Biden administration will come after many of the tax cuts that took place during the previous administration. But we don't think that's going to happen for the 2021 tax year. We think it's more likely to affect 2022. And so this is a key year for people to think about Roth conversions, to think about managing income at lower brackets than we've seen in the last 10 years, because we just believe those brackets are likely to go up next year.
Yeah, we definitely see this as, especially if you're in the situation of close to within 5 years of retirement or retired. These next few years in planning is going to be really critical. And we know that these tax issues really can be complicated. And we know many of you are starting to think about the taxes, as I said earlier, and really Hilltop Tax Solutions offers tax planning and tax preparation for individuals and businesses. And right now we are offering a 20% discount on your tax returns to get them prepared. A 20% discount. We're going to have limited availability for new clients, so you want to take advantage of this offer. So I would encourage you to call us today at the number on the screen, 574-633-1476. What you're going to want to do is say, I want to take advantage of that tax preparation, 20% off. Get your name. We'll get your name, email address, and phone number. That'll get you on the list, because opening for new clients are limited. So give us a call today to take advantage of it. So still to come on Your Wealth Health, there were also some new tax rules for retirement accounts and education expenses last year. We're going to explain how those may affect you when we come back. Stay with us.
I cannot work, do e-learning, and keep this house clean.
You should try Kay's Way. You heard you were dirty, so we came in a hurry. We can't help you with the e-learning, but we can help you with the cleaning. Try Kay's Way.
Welcome back to Your Wealth Health. I'm Eric Brenner in our new Fort Myers office, enjoying a little bit of sunshine, but really working a lot too. And we opened this office down here because we discovered that so many of our clients spend time down here. And it's also an area where a lot of people from Michiana spend time. So it made some sense to have an office down here if people wanted to meet face to face and also to expand our business. Bill Davis and Matt Arenz are with me today from chilly northern Indiana, and we're talking about tax prep and planning. It's important to get your tax returns filed properly, but you also need to think about strategies that can help you with your taxes in the short term and long term. And we at Hilltop Wealth Solutions believe it's critical to have that holistic approach to taxes. So we all know that 2020 was certainly an unusual year, and we talked about some of the tax considerations, but we also want to address educational expenses and retirement accounts. So Matt, people with 529 plans or educational savings accounts need to be aware of some special situations for their taxes.
Yeah, you're exactly right, Eric. When you have a couple of unique things. So on withdrawing money, you need to make sure that as you withdraw funds for your educational expenses, they are qualified expenses. And there are a list of those qualified expenses on the IRS website and also traditionally on your state website. So you need to make sure that the expenses are being covered out of that educational account. Just comply with that. So you limit taxation of the withdrawal amounts, and you also limit penalties on those withdrawal amounts. The other things that we're telling people to make sure that they prepare for is, the contributions to those accounts do have some tax benefits. So some of them on the federal level, which is the educational savings account, and on the state side, your 529 plans will provide you with a tax benefit, particularly in the state of Indiana, for example. You will receive a 20% tax credit on the dollars that you contribute up to $5,000. So if you contribute $5,000, you'd be looking at a tax credit of $1,000. So it's something that you need to make sure that you attain the proper documentation and work with your tax preparer on so that they know that you would receive that benefit.
Yeah, thanks, Matt. Well, the CARES Act also allowed people to dip into their retirement accounts without penalty before the age of 59 and a half, which I don't believe has happened very often since IRAs were established, Bill. But what do people need to know about some of that info?
Yeah, thanks, Eric. So people could withdraw as much as $100,000 from their retirement account, done by the end of last year, of course, without penalty. So prior to the CARES Act, if you were under the age of 59 and a half, you'd have a 10% penalty on top of the taxes. Now, it's never a great idea to pull from retirement accounts because we lose that power of compounding over time. But if you really had to, you're not going to be faced with that 10% early withdrawal penalty. And in addition, if you did take out $100,000, for example, you would have a significant tax bill. If you were in the 22% tax bracket, you could be subject to $22,000 worth of taxes. And so under the CARES Act, they're going to allow you to pay that over 3 years. So the ability to spread out $6,000, $7,000 a year for an individual that just found themselves in that situation, got furloughed, lost their job, needed to tap into retirement accounts to literally just pay their expenses. There's plenty of favorable tax treatment, and especially the spreading out of the taxes over a 3-year period is a big one.
Yeah,
Eric, and I think one more point there is that Bill brought up is if for some reason you are you regain employment in that period, or you have a different strategy on how you can get money put back in that account, you do have a 60-day window to return the money to the IRA that you withdrew from and avoid those income taxes. So that is something that we would recommend, that if you didn't know about that you work with your advisor and your tax preparer to coordinate that effort.
Yeah, that's a great point. And another point is you want to be careful because it allows every year, 365-day withdrawal. So you don't want to do more than one a year, and
Right.
it's not based on a calendar year. So again, like you said, Matt, you want to make sure that you get professional guidance and advice on that. So, another important issue that we talk about all the time here is Roth IRAs, right? Taxes right now are at the lowest they've been in 40 years. And the likelihood of them going up is pretty high. If not this year, then next year, Matt. And so now maybe the time to really, again, start planning and thinking about Roth IRA, whether contribution or conversion.
You're exactly right. Pay attention to where you're putting your dollars for while you're saving. Look at what are the benefits of tax deferred growth and then tax free withdrawals versus taxable withdrawals. Conversions. Bill's point earlier in the show was if tax laws do change in 2022, they're probably going to go up based on expectations, and so. Are there opportunities for you today for conversion or contributions into Roth versus traditional? Those are going to be big things that you need to work through and plan. You also need to see what the impact is on your taxes based on the strategies that you're using. And I think one other thing, is just make sure that if you are putting those funds in the appropriate account, that your tax preparer knows which account that you're putting them into. We have seen circumstances where tax preparers have filed that incorrectly for people, put Roth contributions on the traditional side or traditional contributions on the Roth side, and that will create some tax complications that you'd never want to experience.
Yeah, that is for sure. So another thing that we've talked a bit on this show is the Secure Act that happened January 1st, 2020. And Bill, that pushed required minimum distributions from 70.5 to 72. So people have a little bit more time. And then, of course, the CARES Act that was passed last March has helped or suspended those required minimum distributions. And so we just feel like we call this the window of opportunity, right? The planning opportunity here from your age currently. So if you're 65 to 72, you just got an opportunity here to really take a look at your situation and see if you can set yourself up or your beneficiaries up with some tax-free money.
Yeah, because most people will continue to defer because of the taxability of the withdrawals. And so now the longer you defer 2 more years, and you get that growth factor. Now the required minimum is going to be even greater, and the fact that that now they've taken away the stretch IRA as an option for the non-spouse beneficiaries, that's going to compound the taxes for an individual while they're alive and for their retirement, and it will also compound the tax implications to a non-spouse beneficiary. So we just think that there's a lot of good opportunities with the RMD going to 72. It adds a couple of years to plan, and but at any stage after 59 and a half, we should be thinking about planning for reducing the required minimum when you get to the age of 72, and reducing the tax implications on the next generation.
Yeah, and this is not about product. This is about advice, and it's really important to have a fiduciary that absolutely by law needs to work in the best interest of you, the client. So that's really important. So we all know that taxes can be complicated, and we know many of you are starting to think about your taxes. Hilltop Tax Solutions offers tax planning and tax preparation for individuals and businesses. And right now you can get 20% discount on your tax returns. And what you need to do is you need to call the number on the screen, 574-633-1476. We're offering that to new clients, but we think that they're going to fill up and we're going to just not be able to take everybody. So we encourage you to call today to take advantage of what we call the early bird special. Still to come on Your Wealth Health, a checklist of items you need to get to your taxes done correctly and why it's smart to get your taxes done early. Stay with us. Welcome back to Your Wealth Health. I'm Eric Brenner along with Bill Davis and Matt Arenz, and we've been talking about tax preparation, and we wanted to remind you of some of the basic things you're going to need to get your returns done correctly, beginning with some of the basic personal information. So, Bill, we just start with the basics, W-2s from employers, maybe if you're unemployed, the 1099, those documents that folks probably are already seeing coming in.
Yeah. So that graphic outlines the two key documents. If you did receive any unemployment income, your state will issue you a 1099-G. Hopefully, you've prepared for any taxes that might be due on that. And then, pretty simple form that everybody's used to is the W-2 from the employers.
And Bill, if someone's self-employed, recording all expenses, kind of too late to go back. I mean, you could go back and recreate, but making sure you've attributed all the expenses that go towards your business, especially in a year maybe where you want the deductions and you want to try to keep your income lower because maybe it has been a struggle.
Yeah, we do have a graphic on this too to remind those self-employed people to, either issue 1099s to vendors, may have K1 income, they may have 1099 miscellaneous or NEC, and however they're recording their expenses, that's going to be an important piece of information to prepare the taxes. Business use asset information, so the cost, the date placed in service for depreciation of business, business equipment, and then a record of the estimated tax payments that were made. So the coupons are referred to as 1040 ESs, and so if you did pay quarterlies based on input from your CPA, you're going to make sure you have that available for you as well.
And Matt, you mentioned it about IRAs before, but I think it's worth mentioning that someone can, if they're allowed to, they can contribute to a traditional IRA or Roth IRA up until April 15th.
Correct. So you can still make contributions to those retirement accounts up to the tax deadline. So as you prepare for your taxes, if you're looking for some additional strategies based on do you owe money or are you getting a refund, you can work with your preparer on making prior year contributions.
So, Bill, a lot less people are able to itemize now since they made the change a few years ago with the tax law change. And, they say, well, it's not worth even tracking, charitable deductions, medical expenses, and so forth. So sometimes if they're close, they really still need to weigh the option, don't they?
Yeah, that's true. But I mean, it's just not very likely that someone's going to have that significant of amount of either charitable contributions or the kinds of limits that are put on deductible items. At 24,000 for a under 65 couple, that would be a lot of itemized deductions. But I still tell people to track your medical expenses, track your miles, all the things that you did prior to the itemized or the standard deduction going up to 12 and 24. But the likelihood that you're going to use those itemized deductions is probably pretty low.
Yeah, that is a good point. I mean, if someone's got a lot of medical and maybe someone's staying in a assisted living or having help at home and they're paying for it, I mean, they could get there, but it's still a lot of medical expenses. So the 1099s, interest, dividends, those kind of statements really don't come out from the investment firms until mid-February, right, Bill?
That's correct. Yeah. So don't even be thinking about. In fact, many of the investment accounts don't come out till March. So I know that it shrinks the amount of tax, tax preparation time, but you're not going to be able to complete your tax return until you get all of those 1099s that do report the interest, the dividends, the every stock sales, everything to do with your investment accounts.
Yeah, and that's a great point, Matt. And that we tell our clients, I know, that have investments, say really wait till March 1st or March 1st to be able to take it in and start thinking about getting your taxes prepared.
Yeah, and I think a lot of tax preparers these days are saying, "Hey, we can at least get a jump start on your tax return and preparation." And as you get some of those lingering documents, bring those in, and that'll just close it up for the year. But there's no sense in trying to get it done if you know that those documents are going to be straggling in. But you can at least get a start on it, preparing it, accumulating it, and giving it to your tax preparer, so that you're not coming in a couple of days before the deadline, hoping to get that done.
Yeah, thanks, Matt. So once again, we know all of these tax issues can be complicated, and we know many of you are starting to think about your taxes, and you don't want to wait until the last minute. We can help at Hilltop Tax Solutions. We offer tax planning and tax preparation for individuals and businesses. And right now, you can get a 20% discount on your tax returns if you respond soon. We also offer accounting and bookkeeping services for small businesses, and you can get a 10% discount on those services. So you can check this out at hilltoptax.com, or you can call the number on your screen. Well, this is going to be our last show on Fox Michiana, but Your Wealth Health will continue. It'll still be a weekly show and will appear on yourwealthhealth.com and our YouTube channel. We are committed to providing you with financial information and education, but we want to make it more innovative and efficient format for you, the viewers. We also want to make it more convenient. You can watch it at any time on yourwealthhealth.com. The segment will be a little shorter, so you don't have to invest as much time, but there'll still be a full valuable information to help you with the finances. So please join us for Your Wealth Health in the very near future on yourwealthhealth.com. Well, for Bill Davis, Matt Arenz, and the entire Hilltop Wealth Solutions team, thanks for watching. We hope to see you again on yourwealthhealth.com. Until then, stay wealthy, Michiana.